Hello, everyone. This is Kim Arthur, the CEO, CIO of Main Management. I am very excited today to kick off our monthly series highlighting partner perspectives. And I have a very dear friend and partner of the firm, partnership with the firm, Danielle Meister. Danielle, great to see you today. I know you're an advisor with Madrona Financial. Uh, we have similarities where you guys are a team of 30, we're a team of 27. So I like that. And I know we share a passion for client first, which is very, very, very important. I know also you've got some great pieces like your certified financial fiduciary, certified divorce financial analyst, and your podcast, You're Growing Her Wealth. You have some incredible storytelling and some incredible content. So I'm really, really pleased to have you, not only an advisor, podcaster, mother of two daughters. Welcome.
Thank you so much for having me.
Great, great. So I thought what would be very interesting is, again, you are a master storyteller, and you lend so much to your clients on educating them, which is the key, and being a trusted advisor. So I thought maybe you could kind of, tell us, kind of lead into that, and talk about what makes you you, and what makes you tick, and how you're good at what you do.
Yeah, happy to. I started Growing Her Wealth as a brand that's tailored really to help women build financial confidence. And so it's in retirement, wealth planning, investing, tax strategy, gifting, legacy planning. And it's a conversation that traditionally women have been left out of. And what I find that for men, that there's a really fundamental role in I'm taking care of my family, I'm taking care of my spouse. So this caretaking comes from a really deeply rooted place of love and caring. But what it does is it creates blind spots for when most likely she will be in charge of finances one day. And what's crazy is statistically, there's a 65% chance that women are going to outlive their male partner by 12 years. So, guys, we're kind of planning for the second to die, right? And if we aren't bringing her in now, what it does is it ends up leaving women and your family legacy compromised.
Yeah.
So I've created this brand. It's Growing Her Wealth. It's a podcast, website, and it emphasizes a woman's perspective, but the message is extremely balanced. It's inclusive. I want to think of this as a collaborative family stewardship of wealth, right? So it's a collaboration between men and women and all of the men and women in your lives because this is about husbands, sons, fathers, mothers, daughters. It's all intertwined so much more than it appears on the surface. And so that's really the gist of what we're trying to do, what we're trying to accomplish. I don't work with just women. I work
Yep.
with men. I work with households, families. So it gives you a little bit of an idea of, my 15 years in the industry.
Oh, it's well, and like you said, there's 89 trillion with the T dollars that the baby boomers have. And to your point, most of that is males are in control of it. But like you said, with the longevity aspect, 75% of that money is going to flow down to females. So, like you said, it's not a male female deal, but it's an education situation. So
Yes,
that's
it's a
what
welcome in. Come into the
exactly.
conversation.
Come on into the conversation 100%. And there's nothing better than financial literacy because people are going to do much smarter things. So it's very, very interesting. So if you look, like, maybe you could talk a little bit about some real life confidence disruptors. I'm sure you see a lot of those. How do you handle those?
Yeah, there's so many, and it starts from, I sit out, I go to lunch with a girlfriend or a group of girlfriends, and the last thing that we're ever going to talk about is finances. So there's so many taboo conversations that have become more acceptable and mainstream, but finances and wealth and taxes still don't seem to be one of them.
Yeah.
But one, and I'll share a couple of stories here,
Yeah.
but the one that I want to start with is I work with a woman who worked at Boeing for 32 years. Okay. So she started as a mechanic and just like most people when they get started in their job, they're offered a company retirement plan. And so she starts investing in the 401k plan at age 19. She's getting the company match. What do I even invest into? I don't know. A target date fund? Sure. Some company stock? I don't know. And she just leaves it, right? It's a set it and forget it. She gets busy. She's growing a career. She gets married. She has kids. She gets divorced. She remarries. She's still climbing the corporate ladder. They're sending her internationally around the world. And guess what? The 401k is so out of sight, out of mind. She just thinks, I've got it. I'm investing. I've got a match. And for 20 or 30 years, it's never looked at. And I see this all the time because as soon as you start to think, "Ooh, I'm getting a little bit closer to retirement. It's time for me to start paying attention," is when this like fear and anxiety starts to set in, right? And you've been growing, 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 but you're not going to work forever. And we need to think about how are we going to transition this? You're insecure and we don't know what the next step is. How do I get this right? What changes do I need to make? How do I support myself in my life once I'm not working? And so this is a very real scenario. I would say, 80% of clients come to me with a really large 401k or tax deferred IRA. And the next step and the question that we have is like, what do we do with this?
We do. Yeah. Do you find that in those situations, I've seen a lot where when people make their initial allocations into 401ks, it's very market dependent. And it depends like whatever the hot asset class is at that time, that's what they kind of click on and they walk away, which is why it's good if they have more of a, I know target dates have some of their issues around it, but if it's a longer dated target date and it's going to be growth equities, probably good. But what do you do, around those situations where you look at it, you're like, "Oh, you must have invested this during the last commodity bubble because you've got 56% energy that's inside of your portfolio."
I know it's a real problem because it's this set it and forget it. And a lot of times people, like a really good example is the 60/40 stock bond split. And when you're inside of a 401k plan, especially, you've got this little cute menu to choose from. And there's not a lot of options. So
Uh,
people say, well, I don't know what to do. Maybe I'll put some stocks in there and some bonds in there. But if you look at the bond egg over the last 5, 10, 15 years,
yep,
it's kind of done next to nothing for
yep,
most of the people in those funds. But they don't know that. They've just been told bonds are safe.
yep,
And it's kind of a shame, but there's not typically a person to go to, especially with the 401k plan, to say, well, what should I be investing in? They're like, good luck. The
yeah.
401k plan is for you to manage.
Yeah, which is why it's so important for people to have a trusted advisor, someone like yourself that can look into what they have under the cover and help them make informed decisions. And like you said, so many people they just start plowing the money in there, and they get life gets in the way. I get it. That's what they're there for.
Oh gosh. And it makes me think of there are clients that are way too conservative in their
Yeah,
investing.
yeah,
And this could be a 401k, a 403b, a TSP. It could be a brokerage account, just keeping money in cash at the bank. But one specific example of a woman who came to us, and this could be a male or a female,
sure.
but it was very market dependent and timing dependent and also emotionally
Yep,
driven.
yep,
But this idea of I'm conservative and people just identifying as, oh, no, no, I can't take on risk. So
yep,
a lady came to us, she'd worked for the state for 30 years. And she asked, why is my account balance so low? I've been investing for 30 years. I've been getting a match. I only have a couple 100,000. And my colleagues that have been right here alongside me this entire time, their account values are well into the million, over a million.
right.
And I said, can I see your statement? And I look at her statement and I kid you not, she's in money market.
Oh, geez.
And I asked, okay, so were you ever in the market? Are you just de risking now? And she goes, oh, no, no, no. The market is way too risky for me. And I told her, well, your risk aversion has cost you your retirement. Your colleagues get to retire, and either you're going to keep working or you're massively going to adjust your lifestyle because you decided to be too conservative and stay in cash.
Yeah.
So it plays right into the idea of maybe it was market dependent, maybe it was just an emotional decision that was made many years ago, set it and forget it, and you sat in
Yep.
cash for 30 years.
It's so that brings up an interesting topic because I know in I think 2011 and 12, a good friend of mine started a company here in San Francisco, and he had about 50 employees, and they were all I call them kids. They were fresh out of college, so let's say they're 24 years old. And I remember asking him in 2012, and remember the bottom of the great financial crisis was the first quarter of 2009, so we're 3 years past that. And I said, "What does the retirement account asset allocation look like amongst your 22, 23, 24 year olds?" He said, "They're all in cash."
Panic, fear.
Total panic, and what happened there is it was a behavioral issue. They had watched their parents probably go through the 2002 down draw. Then as they were just about to get out of college, they experienced the stock market going straight down. So they had this recency bias and a true bias from watching their parents. So they're like, in spite of the fact that they have 70 years of compounding in front of them. How do you how do you deal with that?
You know what? I'm actually a product of coming out of college in 2006
There
and
we
getting
go.
into right? My first
Yep,
401k plan was in 2008,
yep,
and I had a trusted advisor. He wasn't a financial advisor, but he was a guy who was into the stock market. He
yep.
sat me down at a Marie Callender's, up in Santa Barbara, California. He opened up my 401k account and selected the investments for me. And
Love it.
thank goodness, because my
What
set
a
it and forget
hero
it
that
was
guy is. Yeah. Yeah,
yeah, and so I had a person. It
yeah,
wasn't a mom, it wasn't a dad, it wasn't a financial advisor, but it was a trusted friend and a confidant, and I
yep.
look back on that and think, "Thank you," because
Thank
that
you.
made a huge difference in my life.
Yeah, and we do a lot of I do a lot of that here with because we have a lot of young people that join here, and the first thing I tell them is, "Listen, your fixed income allocation, that's called your job, your job here. That is where you are getting the money to run your railroad. So your early 20s, you have to have a long-term horizon. It's all about time in the market. I love, and then I'll pull out like the picture for the last I've been in the markets now. I got in 1987, so it's been 38 years. During that 38 years, Danielle, there have been 20% plus drawdowns every 4 years. Every 4 years, a 20 plus percent drawdown. And oh, by the way, each individual year had on average a 13%. So it's kind of like you get a 13 to 13, and then every 4 year you get a 20 plus. And in spite of all that, over that 38-year period, the markets have been up 10% a year. Exactly. So when I pull that out and show them, the picture is north by northeast, and I say that it's a feature of the market to have these corrections that keeps the animal spirits kind of contained and allows for a bull market. And I look at that, and then you show them the picture of cash, that's 3% and inflation at 3, so you're not making any money. So it's all about perspective. And it sounds like that person at Marie Callender's, that was awesome. They obviously understood that and said, Danielle, here's the right things.
Right, and the reality is most people don't have that little angel on their shoulder at 20, 3, 24.
Yep.
They're starting to make these big decisions at 50,
Right.
55,
That's right.
59, and they're saying, "Oh gosh, I'm retiring in 5 years.
Yep.
Did I do the right thing, and am I on the right track now?"
Yep.
And what's really cool is that at 59 and a half, you all of a sudden can say, "Well, I wanna do an in-service distribution, or I wanna move that money over into an IRA. I can control this thing now." And so now sky's the limit on my investment choices, right? I can get into, I can get into outside the market allocations. I can be in real estate. I can be in private credit. I can get into sector rotation. I can have some options for creating income strategies. So all of a sudden you're like, you've been in this box and you like explode out of it. But how do you do that? Well, one, if you're a do-it-yourself investor, you don't have access to these things,
Yep.
or if you don't have an advisor, like, how do you even know that these things are out there?
Oh, yeah. And it kinda reminds me, and I know it's gone through many iterations, but TGIF, thank God it's Friday's Restaurants, which they've been in and out of bankruptcy, but I used to remember First time I went there, it was a phone book, and I know for a lot of the younger people, you probably don't know what a phone book is, but
A
just think of
payphone,
something a payphone, right? And
coins.
coins and but I remember you'd walk in and you'd look at that menu that was the size of a Bell, an AT&T phone book there, and you'd be overwhelmed, and you would, when the waiter or waitress came over, they'd say, "Can I help you?" You're like, I'm good. I'm just gonna leave. I can't make a choice."
Yeah.
It's like, again, it goes back to where when they do have that all the choices, they better have a trusted advisor that can give them perspective about what they're supposed to be doing at age 59, like you talked about earlier, as opposed to age 22. Those are very, very, very different allocations.
Right, now would I love to be on board at 22 and start to, like, point your compass in the right direction right out the gate? Sure. It doesn't naturally tend to occur as frequently that way.
Yeah.
Now I've got a number of 40-year-olds and 50-year-olds, and so we definitely have this awesome runway, and we get to plan and make decisions for where we wanna go a little bit earlier. Um, but I would say there's some really interesting hurdles that women and men have to overcome that maybe they weren't planning for. One thing I see quite often is I'm a certified divorce financial
Yep.
analyst, and then also working with a lot of baby boomers, is we're helping people navigate through widowhood and navigate divorce.
Yeah.
And one of the things that most people aren't thinking about, because we've talked quite a bit about IRAs, and so while we're on this topic, is an IRA. Okay, so imagine you're grieving, you're potentially losing the lower of two social securities, so income streams. Maybe you had a reduction in a pension or, you know, some sort of other income that's coming
Yep.
in. And for 40 years, you've never sat in the driver's seat. And
Yeah.
all of a sudden, you've got to make all the decisions. And now, on top of this, you're going to get a major tax hit.
Oh,
Okay. You've been married filing jointly for 40 years. And all of a sudden, your filing status is going to be turned to single. Well, I work for a CPA firm. We've got 13 full-time
yeah.
CPAs on staff, so a ton of the work that we do is in the tax and tax planning space. Now, there's this illusion that I've got all this money stuffed away in an IRA account, and I would argue that you've really got just a big pre-tax ticking tax time bomb, and that this is actually a liability for you that we
Mhm.
need to plan for way in advance. While everybody's healthy and there's opportunities to draw down the IRA accounts at a more tax advantaged tax rate, there's opportunities to do Roth conversions maybe in low income years. And
Mhm.
maybe we're doing qualified charitable distributions. That's just a fancy way for saying tax advantaged
Right.
gifting to charity.
Right.
And I want to draw these things down because story, real person, husband passed away. She was 75, very healthy, lived to 95. So for 20 years,
Wow.
she outlived her husband. They had $2 million in IRA accounts, and we did the calculation because I work in this space. I'm curious about the numbers. I work for
Yep.
a CPA firm. I should know this. So we ran the numbers on it. Married filing jointly versus her transitioning over into being a single widow because of her forced required minimum distributions. So this is the IRS
Yeah.
knocking at her door and saying,
Yep.
"You must draw down these retirement portfolios." She ended up paying $189,000 more in taxes, so almost $200,000 more in taxes
Ouch. Ouch.
just because of her tax filing status.
Wow.
So why are we not thinking about these things
Yeah.
in advance?
Yeah. Yeah. I mean, think about that on a $2 million balance. That's 10% that gets paid out to taxes, which of course she had no idea.
No idea.
No way.
No, and
Yeah.
there's no going back. I mean, we can't
Yeah.
we can't change any of that.
You can't change that. You can't change that. No.
And
Well,
and there's
well,
so many other ways. It's not just how we draw down from an IRA account, it's looking at non-qualified accounts and so many ways that we can be tax advantaged there too, like just the idea of mutual funds versus ETFs.
yeah. Yeah. No, it's another topic that I'm curious how you kind of address it. There's all kinds of emotional volatility that people experience because of what they see in the headlines, what they see going on, or even simple things. people talk about this K economy, and one of the Ks, it's a bifurcated, but another way to look at it, it's the K economy. The shape of the K is the stock market up and to the right, and consumer confidence down to the bottom lower right hand corner. That creates a K. And a lot of people see these consumer confidence surveys. There's one that's very, very visible from the conference board, and the numbers range between a high when consumers are very excited at 140, and then when they're very despondent, it's down at 50. And it right now is at 85. Okay. So it's kind of in the lower range there. 2019, it was at 140. So it's dropped 40% in the last 6+ years. But you know what the stock market has done? Up 155% during that time.
Such a
So
mismatch.
100% mismatch, and that's another one of these disservices when the average person says, "Well, the consumer confidence, that must be, 70% of the economy is the consumer. If they're despondent or not feeling good, it can't be good." You're like, "No, let's back up and see what really matters. Why is that the K on the upper with the market going up? It's because it's all about real wages. That's what people get to, eat with, and they get to pay their mortgages with. So as long as you have real wages, which we do, they run on average 1+%. Doesn't sound like a lot, but that's all you need to make the system run. And then it's earnings from the companies. But that's another mismatch. And so I'm sure you must run into people that think, things don't look, they ask you, how can the market be up when everything's so awful?
Gosh, this comes down to being extremely diligent and making sure that we've got a robust plan in place.
Yeah.
And at our firm, we've been at this 30 years, so we've put together what's called our 7 steps to a rooted wealth plan. And what we're doing is going through first, and I'll go through the 7 steps. I don't
Yeah.
wanna do a crazy deep dive into each one,
Yep.
but maybe I can highlight just a couple at the
Sure.
beginning.
Love to hear that.
And what we do is first talk about somebody's lifestyle because I have no business making recommendations until I truly understand where we're coming from, where we're at today, and where we want this thing to go. And money serves a purpose. So, what purpose is it going to serve for you? Do you want to travel? Do you want to spend time with loved ones? Do you want to have meaningful experiences? Do you like golfing? Do you play pickleball? Because none of this matters until we understand exactly what your life is going to look like. And I think that immediately starts to it 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 detaches people a little bit from the news, the noise, the everything going on outside of their control, and we just start to look at what's going on in their own lives and their own families' lives. And we can say, "Well, for serving you and your family, what do we need most?" So, step number 2 is cash flow planning. A lot of people are exiting the workforce and entering into
Yep.
this next phase of life where we need to create cash flow. And it's tricky because the S&P 500 alone, just the stock
Yep.
market by itself, isn't really a great cash flow tool.
Right.
And,
Right.
we go back to this Boeing employee that we talked about earlier, and we need to transition by creating multiple levers and lots of different da income levers that we can pull on. I don't just want a one-trick pony approach to this thing. I wanna have private real estate, I wanna have private credit, I wanna have a, buy right strategy, I wanna have a income annuity. I want all of these different income pieces so that if one gets a little weird over here, or one isn't great for inflationary, maybe this one is. We've got lots of different tools in the toolbox. So the second step is this cash flow planning piece. But I wanted to see if you wanted to make any comments here.
Yeah, no, I'm fascinated because you're right on the right track there. You have to have, we do a lot of model building for advisors, and we do exactly what you're just saying for very specific situations there, whether it's addressing longevity, whether it's addressing income, whether it's addressing, whatever their goals are. So you have to have these different models that can go ahead and achieve what you're talking about. So go ahead and continue. I like
Yeah,
I
I
like
mean,
hearing about these.
I think once somebody has a good grasp on,
Yep,
I need this, you
yep,
can give me that. Oh, wait, my expenses are X and I can cover that. Oh, now I can maybe talk to the lady who says, I won't invest in the market. I'm not aggressive. I'm too conservative
Right.
because now she has the confidence to go spend her money
Yep.
to achieve her goals,
Yep.
right? Because money serves a purpose.
Big
Now we
time.
can talk about growth planning. And I can't talk about growth planning until I did those other two things. Otherwise, it's out of order.
Yeah.
And so now we can say, well, I, personally, we're not using a lot of mutual funds, but we can start to look into growth planning and using exchange traded funds. They're more tax advantaged. We're
Hmm.
using sector rotation strategies. We're looking for active trends in international or interest rates. What's going on with interest rates, technology, AI, data centers? What's interesting, growing? Where are the tides headed?
Yep.
And this way, we can create a financial plan for somebody, project out 30 years, use really conservative growth rates, but start to kick the tires on different levels of risk. And how much risk can we take and still make sure that you don't run out of money at age 95 or 100?
That's right. And risk is always a tricky thing because you ask someone when the market's straight up what their risk tolerance is, and they're like, it's unlimited. And the minute that it goes down, you ask that same person, what's your risk tolerance? They're like, I got no risk. I got no risk tolerance. And we always like to use it's a little blunt tool, but a blunt statement. But I always like to say that fear is temporary, but greed is permanent. And that's why you get the shape of the market over the long term there is that, people are much more inclined to try to find things that are productive that they can build and make a better society, a better community. So, but yeah, it's trying to keep that contained there. So what I love about that, Danielle, is that you clearly like you said, you can't make a recommendation to a client until you get to know who they are, what their goals are, what the all those other pieces there, and it's all part of building a meaningful relationship, and then you being the trusted advisor that they can look at. It's like, and you guys obviously, I love how you have you said 13 CPAs. I mean, that is invaluable because there's so much that you guys can add.
It's crazy. Most advisors will say that we do tax work, but they've never opened up a tax return. Or they'll say, "Send me the tax return," but they're scared to death to open it up. Or you say, "What's a 1040?" And they don't know what a 1040 is. Well, that's just your individual tax return. That's
Right.
like the first section. So,
Oh,
if we can start to go through the different schedules within the tax return with a client, look for opportunities. Maybe there's an asset sale coming up. When the asset sale is on the tax return, it's too
yeah,
late for me to do
too late.
planning. I
Right.
need to know about it beforehand so we can do tax loss harvesting strategies in advance.
Yeah.
We come back to the widow tax. I want to draw down these IRA accounts strategically. I don't
Yeah.
want to, crush you with tax brackets and Medicare surcharges.
Sure.
We'll be mindful of all
Oh,
these
yeah.
things.
Yeah.
But that kind of brings up that next, we've got the 7 steps. So number
Yep.
4 is tax planning, and
Yep.
I'll briefly run through number 5 is protection planning, so longevity,
Absolutely.
long-term care, and then gifting is number 5, so
Yep.
advanced gifting strategies, charitable organizations. Washington just increased its death tax penalty, so if you die with more than $3 million in your net worth, be prepared to pay money to the state.
Oof.
Lots of strategies that you can deploy before those the end of your life comes.
Yeah.
And then legacy and estate planning. So if we are covering all of those 7 steps and we're creating and customizing plans, it comes back full circle to this idea of fear, the markets, what's going on in the news. Get that noise out of here. Let's focus on making sure that we get all the 7 pieces of your planning and wealth
Yep.
right. And
Yep.
it starts to remove these really deeply embedded fears that people live with for decades.
Yeah. Interesting. I was thinking on the planning side there's a gentleman, Art Laffer, who was a professor at USC, was known for the Laffer curve, and he helped out the Reagan administration. So this was a long, long, long time ago. But about 15 years ago, he was living in California, just outside of San Diego. And he decided that the People's Republic of California was a little too expensive for him. So he did an exhaustive survey of all 50 states to find out where it would be the best place for him to continue. He was still working at that time, but to continue to work and then also to go into his retirement years. He picked Tennessee out of the 50 states. Now, Tennessee, when he did go there originally, like what Washington just put on, they had a very onerous death tax. But he knew that the legislation was in the process of getting ready to change that. So he moved there, and then shortly after they changed that, and he's like, "I got it." But it was now. I'm not saying that everybody's gonna do examine all 50 states there. But again, you guys having all the data and the ability to kind of help make people make informed decisions. Awesome, awesome. So let me ask you, as we get towards the end of this year, I wanted to ask you, um, with your 2 daughters, I know obviously you were a very competitive soccer player, and very good at what you did, and your husband is, these are my words, he's gotta be, a hell of an adrenaline junkie if he's flying Black Hawk helicopters. So I'm curious, what are your 2 daughters? Which path are they going after? Are they going after mommy, daddy, or their own path?
Oh gosh, I've got one that's my adrenaline junkie. She's more my natural athlete, but she's a hothead, so it's gonna be interesting to see how that plays out. And then I've got another one that's so intrinsically motivated, you can't bribe her with anything, but if she wants to do it, she'll work hard and practice on her own and, not such a hothead, and I'm curious how it's gonna play out, but both of them are in soccer, both of them are, already skiing because we're a
That's
ski family just like you. This is one of the things we've gotten to do together, and you're a phenomenal skier, that's been a blast.
Oh.
But I think we're gonna be, we're a ski family and a soccer family, and I'm hoping that neither of them fly Black Hawk helicopters.
I love it. I love it. So any other, parting comments you wanna say? I wanna throw in one, and then I'd love to hear yours, and that is, clients are extremely fortunate to have an advisor like you that is so passionate about doing the right thing for them, educating them, and helping them make informed decisions. So, I can't say enough about that because you are doing, yeah, this is incredible work. So, A, I wanna say that. B, I wanna thank you and your firm, Madrona Financial, and CPAs for the great partnership that we have. And I'll hand it to you for the closing comments.
Well, and I'll take it from there because we couldn't do this without the strategic partnerships and alliances that we formed, and the portion of the portfolios that we align on and that we collaborate on is so important, and it delivers real results for the clients. So, um, can't say enough about the partnership and collaboration there. But I think, the market, in my opinion, in closing, the
Yep.
market's not always gonna go up. But a well-designed portfolio and partners that support our strategies, we create enduring financial plans. And the goal is that we don't want a client to ever feel like they're not in control. We want confidence, we want peace of mind, and that goes for all the financial decisions ahead.
Yeah, I love it. That's well put. It is all about time in the market, not timing the market. This is a long dated. This is a marathon. This is
It
not a
is.
sprint.
Yeah.
Yeah, and the sooner people know. Well, this has been awesome. It's so good to have you as our flagship first in this series here, and I look forward to seeing you in Chicago in March too.
Yeah, so happy to be here. See you soon.
Sounds good. Thank you.